businesses are becoming very exponential. 60% of energy startup inflow already had revenues when they came in, but they were raising money, equity funds for working capital as a simple example, right? So there is some kind of disconnect here. And more than 25% of these enterprises actually went on and started raising debt. So in a very short time frame of these enterprises, they do end up raising multiple forms of capital. And a meaning to this enterprise can happen if you catch the journey of these enterprises in the first few years with different forms of capital. So that's kind of the second point. The third point is because of this whole internet penetration, so think Amazon, think of its suppliers. So there have been a lot of enterprises that are not startup per se, but have been around for a long time. But suddenly, because of their presence in the web, they're seeing huge amount of growth, and they're exhibiting growth characteristics of a startup. And that is something that's fundamentally changing. So what this means is not just e-commerce, because that's traditionally how we think, but I'll take a couple of Indian examples. So there's a company called Now Floats, which has suddenly over the last year or so put 273,000 SMEs out there on the web. So their proposition to SMEs is, I will take you on the web, I will do all your web analytics, SEO and so on. These guys have suddenly become accessible. Just we have to get all of these things together. Next slide, please.
Can I ask what the numbers mean, please?
Sorry?
If you go back to the previous slide.
Mm-hmm.
Like 8 times decade-old apparel business. What's the 8 times?
So 8 times sales. So they were a decade-old apparel business, and they just went online, and their sales went 8 times. In 2 years. And so here is a company which had not raised various forms of capital, is suddenly exposed to different forms of capital in a very short time frame. And there is crowd wisdom around that. I mean, how they're performing, the sentiments around them, and so on. So if you think about these examples, these are some of the companies that are live as we speak, that we are, helping them raise capital on. You can see the differences in the kind of transactions they can go through. So there's a healthcare startup that's doing a defibrillator, which is mechanical, if I get technical there, which has different kinds of stages that it needs to go through. There is a platform which is more a telemedicine kind of a platform, which is very software, which is very different from a mechanical kind of an equipment. There is an alternative to carbon fiber prosthetics using cane, which is very, strength of material kind of oriented. So the kind of certifications and so on that they have to go through is very different. But today, if you see, all of these people are raising the same form of capital from the same kind of institutions. On the other hand, if you take a restaurant which is online, which is processing a lot of transactions online, they're again trying to access similar form of capital, though the nature of the business, the nature of uncertainty and risk in all of these is fundamentally different. What these guys need is more of prototyping fund, right, where you track engineering milestones, which is trackable given the technologies I said. What these guys need is a mechanism by which their point of sales transactions can be actually factored in, which is what we do as an organization today. So we have an offering through our group company called IntelliCash, where we lend based and take the debits out of point of sales transactions. So it is very short-term loans, and we can track their sales, and we take just a cut out of their point of sales transactions. So we need what I call as aligned capital. So it is aligned to the risk that that particular activity is taking, and then you combine it in terms of blending it. So what we mean by that is, again, if you take any of these transactions, different investors will have different risk profiles. So you pool together investors so that somebody comes in and says, I will take a first loss guarantee. So once you take that, the risk profile changes, and then you can bring in a lot of other investors onto the same platform to do this blended financing to some of these activities. So that's kind of where we are going, the last chart. So our positioning is to focus on the enterprise journey, which is becoming exponential, and the meaning to this enterprise comes in a very few years, and they will do multiple types of transactions. How do you give them aligned and blended capital? So that's kind of where we are coming from. Thank you.
Root Capital is an organization which focuses on investing in agribusinesses, which build sustainable rural livelihoods. We provide two things mainly: lending capital, debt, We also deliver financial training because we appreciate that farmer groups and private businesses go through significant challenges in building the financial systems. So why do we deal with SMEs and producer organizations? One is because a lot of our clients aggregate thousands of smaller farmers and hence creating economies of scale. They do link farmers to stable value chains and in a lot of cases share a higher value of the final price. Most are early stage, but not startups, and they are highly impactful, and we hope to accompany their growth over time. And their financing needs will typically be between $50,000 to $2 million. So just to give a bit of example of our trade credit, because that's what is flagged out there. So over time we developed this product to try and make it easier for our clients to provide additional impact. And yeah, just a quick explanation of how it goes. The client, being the farmer organization or SME, would typically have a buyer, or a large-scale buyer, order goods from them, in which case they get into a contractual agreement through a purchase order or a contract. So assuming that we have gone through the usual due diligence and seen that these are fit for purpose and we can provide them with capital, we will go ahead and sign an agreement between the three organizations. That is the buyer, our client, that is the SME or producer organization, and Root Capital. And the agreement is that upon delivering the right quality and volume of product, payments will be made directly to us. So on this basis, we are able to advance 60 to 70% of contract value as a loan, trade credit loan, to these organizations. And this is basically to purchase raw materials, process, and pay for logistics to ensure delivery. So when this is done, the buyer pays 100% to Root Capital. And what we do is we deduct the principal loaned, interest accrued to date, and we wire back the balance of funds to the organization. These are typically treated as lines of credit, so the cycle can continue going on and on and on, depending on the needs of the business. In other products, we also provide assets and equipment finance to support efficiencies in business operations, and also value addition required by these organizations. And typically these are paid from cash generated from operations and are paid between 3 to 5 years. The amounts still remain the same, although we see typically such loans have lower value. In some of the new things we're doing within New Capital, in Latin America, due to the devastating coffee leaf rust disease, together with us, we joined and raised some capital for rehabilitation and renovation. And this is really long-term capital which can serve to ensure farmers can replant and get agronomic support to build up their fields. And these are long-term loans over periods of 7 years with grace periods of about 3 years to ensure they start adding an income. We're also exploring on providing finance to what we call the last mile, people with requirements of less than 50,000. We're thinking of how we can engage microfinance institutions. We have tested with some of the very small organizations, like what Tim will be talking about, and the list goes on and on. Well, thank you. That's a brief overview.
Thank you very much.
I'm Tim Chambers, Managing Director of Inspira Farms. We're a technology R&D company, and we supply off-grid solutions to smallholder farmers, mainly in dairy and agricultural sector. A part of our financial service provider engagement is, at the moment, we're working on a project with Shell Foundation and Small Foundation to look at what the innovations and what the supply is like and how it's evolving for smallholder farm organizations and rural SMEs that are looking to move from supplying and producing and supplying raw materials to doing initial stages of post-harvest value addition and dairy chilling and processing and that type of thing. So we're working with about 75 financial service providers in Kenya, Guatemala, and India. And we've just had a roundtable on Tuesday with about 20 of those financial service providers from Kenya. And these are financing SMEs and cooperatives in the sort of 1 to 250,000 range. So what I think used to be called the missing middle, and now perhaps the not as missing as it used to be middle. Oh, perfect. Thank you. You can skip through the first ones until you get to the photos, please. So just one back. Yeah. So just to give you an idea of what we're talking about, the type of technology we're talking about is solar-powered agricultural machinery and technologies, cold storage, other types of cold chain devices, more traditional agricultural processing machinery, and then more innovative technologies on creating energy from biomass and what have you. Providing long-term financing to SGBs to acquire these productive assets is one of the most efficient and effective ways that you can improve productivity of agribusinesses. And there's a Hystra report from, I think, last year that has quite a lot of that information that gives backing to that, but I think it's probably something that a lot of people working in the agribusiness sector are aware of. But in Kenya, there's still a big gap in availability of this finance. Of all of the financial service providers that we've interviewed, there are about 6 or 7 of them that are financing below 100,000 and as low as 50,000. They're all expecting backward linkages to smallholder farmers. They're all measuring repayment against revenues and these types of things. But technology finance in general represents a relatively low and sometimes very small percentage of the whole portfolios. A lot of financial services are going into shorter-term finance, input finance, and these types of things. And on the next slide, some of the reasons for these bottlenecks. The first two under the risks are probably the most relevant to specifically around technology and value addition, is that the longer you lend for, obviously the more exposure you have to agricultural risks, but the payback periods for a lot of this technology start at 2 to 3 years and sometimes extend even further, and that's been a big barrier for a lot of our financial service partners. At the same time, for a lot of the innovations that are coming out, there's a lot of product or perceived product risk where companies are unable to necessarily prove the longevity of their technology. They're unable to necessarily guarantee or at least demonstrate the resaleability or the resale value of their technology. And I apologize, this is work in progress, so I'm just trying to pick out the points that might be the most interesting. Transaction costs are obviously an issue for short-term finance where you're lending smaller volumes but over a regular basis. That value accrues over time, but if you're doing a one-off technology loan, the transaction cost can be as high as for a much larger loan. The expected returns as well are still under question, so a lot of the finances are trying to make their return on investment from higher priced short-term loans or are lending outside of the agribusiness.
Everyone having their niche in that value chain of bringing access to capital to a lot of people that wouldn't otherwise be able to access it through scale. Right? For example, this small-scale farmer wouldn't be able to access that capital at all to be able to start the process. Whereas what you're doing is enabling that And similar to this asset finance company, you're becoming a step in that process, and just it's a diversion of your cash flow. It's kind of linked in a bit with so it's kind of more organised with better information, more upping professional stuff. So it's being more innovative with collateral. So it's taking a very one of the oldest forms of finance to say, well, let's innovate around it and make it more formal, how you value things, information about where the asset is and how you hold it. And a lot's going to change.
Yeah, so
Well, you can think back to kind of how you might use insurance to underwrite the risk. Is could you have an insurance product which is effectively a mass, every crowd that underwrites. Premium goes to the crowd in exchange for underwriting it. But the risk is spread across so many different individuals, they may be more likely to willing to take that risk than one institution. And again, I think that plays in the technology piece again, so aggregators individuals, so like platforms, and then what information do they get?
So if you had loads of small investments going into a central area, then like you've got a lot of crowdfunding going into this bond, and they're all maybe for the sake of argument like $10. We just know that a sliver of that is kind of allocated to one of the other risky projects.
Securitization.
So it's kind of basically an extra fee. But the extra fee is covering the underwriting.
Which in theory, securitization is a mixed pot of assets. Each risk works.
Very high saturation of cell phones, which obviously lends itself to doing this online kind of stuff. And it also is a very strong barometer. And if you look at actually at Chunga, they try to basically say they're the new digital barometer. So rather than, handing shilling
unsecured, so we engineer the value chain to take different parts of risk. So the retailers take 30% of the risk because they're also our customers. So the producer only carries about 40% of the risk, which and we take, and our donors take 20% or 50% of the risk. So the costs eventually. Our question is how to use soft money in the most strategic ways in accessing energy, Mostly we are from very, very different sectors, and some sectors are using soft money in the R&D, part of prototyping the products, but then also others are integrating soft money within the product offering that they have, and in our case we use that to bridge the distance between the entrepreneur, especially early stage ventures who are immediately post revenues but are still in the survival phase, in accessing market level debt or investments. And so especially in the debt portfolio, we look at how the soft money help reduce the risk, which is a big cost in calculating the cost of debt. We also help in hand-holding because most of the businesses need a lot of investment in business support, deal structuring, market access. So that's where most of the soft money goes. And we find that that is important to make investor-ready businesses for second cycle market level products.
In Europe and in the States, there's been some great advances with auctioning invoices on online platforms. Could the way that we assess personal guarantees change by using technology to database assets or what have you? One of our colleagues here came up with about what they're doing and how personal guarantees are changing the way they're lending to small businesses at the moment. And then being a bit more creative, could we use very old styles of financing and flip them using technologies such as pawnbroking? So this is in Europe again, innovative versions of pawnbroking have come back up by using platforms to be able to load up types of assets you've got, and then investors can link to those and say, yeah, I'm willing to invest if I can secure that asset from you. And that's been quite successful for people who would otherwise have no access to finance. We threw right in the end a bit of a wild card, securitization, which has obviously been fun over the last 10 years, but there could be a new take on an extremely transparent view on could we actually come up with a way of mixing different types of assets together in a very transparent way where investors knowingly get into what they're doing, but could that be used to reduce risk of lending to SMEs in this space? And the last one was being very, very sharp-end, using blockchain type technologies to collect information around accounting information to allow banks to rely on them more availably or more reliably. There you go.
Thank you very much.
Long list.
Long list.
Bringing technology and financial services together to scale finance efficiently. The second one is really around technology platforms, creating an ecosystem or marketplace. And of course, I'm going to entrust my group to keep me honest with this stuff. So an example of this type of thing where most of the banks in Kenya are partnering with M-Pesa to distribute small loans that banks wouldn't be able to otherwise do efficiently. A third point would be around intermediaries, a combination of financial and technical intermediaries that come together, specialize in a particular sector, for example, in the case of Root Capital with rural SMEs and so on. So that allowing, leading into the next point, around increased availability of small-scale asset finance, points that Tim had raised as well, and really being able to focus on a niche and be able to, sorry, this was a point you had raised, around small-scale asset finance, having intermediaries that specialize in small-scale transactions and grouping needs by niche, because it's most of the intermediaries have thresholds that are too large to attract the SMEs. That's the fundamental challenge. The last point is really around service providers as well, entering into this value chain. I think one of the points raised at our last session was around the expectation of financial knowledge and reporting that goes along with taking on debt or equity or any type of innovative finance, and for service providers that help with technical assistance or capacity building so that let's say a small rural farmer can understand how to report metrics around their production, around the cost of production and things like that. Any points I missed? No? Okay, thank you.
Funding in Africa. We took the liberty of narrowing that slightly and phrasing the question around Kenya instead. And we came with 5 key ideas, solutions to that question. The first is more looking at providing mechanisms to reduce the perceived risk of investee companies within Kenya, especially by external investors that perhaps aren't based in the country itself. The second one was to look at improving the transparency then between investors and the investees. So investors having a better understanding of the type of business they're going to invest in, and of course investees being able to more clearly understand the kind of company that wants to put money into their enterprise. Thirdly, we wanted to look at creating a greater sense of connectedness through online community, and that's using some of the existing crowdfunding platforms. It's interesting to note there's only one that we know of crowdfunding platform that's native to Kenya, which is the Mchanga. But you also have VC4A, the 1% Club, and Kiva. So all of these platforms can be used and should be used to create a greater sense of community and connectedness around how people want to communicate their investment opportunities. Penultimately, looking at how we advocate regulatory practices to improve investor confidence. So right now, the regulations around investment in Kenya are weak, and to say the least, and it would be interesting to see how that can be strengthened to provide more confidence to companies that, or investment vehicles that want to invest in African companies. And finally, really trying to improve the current lack of clarity on what the value proposition for these platforms are, particularly for investors. So why should and why would an investor want to invest in a crowdfunding platform in Kenya or perhaps wider in Africa? There we go.
We narrowed the discussion to the models that are at the level of SMEs or small enterprises, and we discussed was mainly about how to combine, equity and debt, and bring in an element of TA or technical assistance in an organization, and therefore targeting that to a core or a strategic aspect of, say, a startup that would help, somehow leverage on the debt or equity that has actually been offered. So it was quite a debate, I must say, of just trying to ask. I'd like to ask a colleague of mine maybe to comment on that.
Okay. And simple, standardized systems, financing from local investors. There's also a lack of seed funding to help people sort of get to the point where they're ready to be investor ready. And there's a missing link between early stage and commercial investment. What do you want to add?
Thank you. We've kind of come to the end of the session. Is there any burning questions, comments anybody's sitting with or want to pose to the group or anything like that? No? Good. Well, then.
It's not a question, we were just thinking about the underwriting risk. And social collateral has been used very effectively in the microfinance context. I think even in the individual lending context, that can be used effectively. And there are people who started exploring that. So we should think a little bit more.
And using the social media.
So using social media, probably getting to know about the borrower, getting people to rate the borrower, some of those things can be done.
Good. And it definitely also happens, I think, in some of the crowdfunding online platforms. But yeah. Good. Any other comments? No? Thank you for coming.